Well, there does seem to be again, another negative day, but don't forget we had that very nice corrective rise in the United States. So there's two really strong performances, in fact, three back-to-back. But however, today, of course, I think the markets are kind of getting back to reality. And the reality to me is that we need to adjust to this new frame of reference that markets and investors are losing faith in the central banks and their ability or capacity to influence financial markets.
So let's talk about that specifically, losing faith here, because we've been talking about the BOJ, the negative interest rates that were introduced a few weeks ago and then went into effect this week. It's only been less than a month, but there's already talk of perhaps a backlash here, that move could have backfired. And we're seeing the yen strengthening. Is that a sign that other central banks as well really are not having the kind of leverage they thought they had before?
I think that's exactly right. I think investors are now coming to the conclusion, and it's a really scary one, that after all these years of acting in a Pavlovian fashion, that whenever the central banks cut interest rates or implemented quantitative easing, financial asset prices rose, equities and bonds. The decision by the Bank of Japan on January the 28th to adopt a negative interest rate initially saw the US dollar rise against the yen, but since that time, of course, the yen has strengthened, as you said, and also the Japanese stock market has fallen sharply. Why? Because banks don't like negative interest rates on excess reserves. And secondly, they don't like flat yield curves because of the impact upon net interest income. So the financial institutions are saying that they are not comfortable with the seemingly desperate measures by central banks and the ECB and also the BOJ. And this is a marked change in perception in the marketplace. So this is very, very important.
Having said that, certainly there is this uncertainty around what the central banks are doing. And like you said, a level of they're not comfortable with what's going on there. But still, investors in the U.S. still looking to the Fed to see where those rate hikes will happen or, how many will happen this year. The fact is that these central banks still have levers that they can pull, right?
They do, but I think they're running out of ammunition. And I think that's what the markets are trying to tell us. And also, don't forget, the thing that really started this sell-off and meltdown in equity markets was really actions and activities in China, and the lack of confidence and faith in the PBOC and indeed even in the Chinese government, particularly in the manner in which they meddled and intervened in the stock market. Yet the Shanghai Composite is massively lower than its highs on June the 12th, 2015. So all in all, investors are really quite concerned that central banks have lost that ability to control markets. Now, Janet Yellen at the Federal Reserve Board, my goodness me, I really don't envy her in this situation. The market is now basically not pricing an additional interest rate hike. Many are now saying that the interest rate hike on December the 16th last year by the US Central Bank was a mistake. So I'm not quite sure about the deliberations at the US Central Bank at the moment, but I'm sure they're very perplexed by what they're seeing in financial asset prices.